Welcome to Lease Accounting Policy Decision for ASC 842, presented by CoStar. Thank you for joining us today. Before we get started, we would like to share some information regarding CPE credits with you, and we appreciate your patience. Today's webinar is worth one continuing professional education credit. Please be sure to enable your media player to hear audio. To be eligible for CPE credit, you must answer at least 3 of the 4 polling questions on the slide screen during the webinar and have a total viewing time of at least 50 minutes. Participants will have the opportunity to download their CPE certificate immediately following the webinar if above requirements are met. In accordance with the standards for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulties disqualify eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements listed above. I encourage you to download today's PowerPoint presentation, which is located in the Resources widget on the lower right-hand side of the screen. After the presentation, this webinar will be available on the FEI member site, where you can replay and download. After the conclusion of the webinar, your CPE certificate will be available in the certification widget and will also be emailed within 24 hours should you meet the criteria. Below the speaker biography widget is the Q&A box. Please feel free to ask questions throughout the presentation, and the speakers will answer as many questions as possible. Now, it is FEI's pleasure to introduce Nick Accordino.
Great. Thank you very much. My name is Nick Accordino. I'm really excited to be with everybody today and have this discussion around the new lease standard. I'm joined today by Matt Waters from CoStar. Just a quick introduction on myself. I'm a partner with Deloitte. I reside in our Cleveland office, and I lead our accounting advisory and transformation services group. Throughout my career, I spent a lot of time in the external audit practice, but over the last 5 to 6 years have spent the majority of my career around adoption of the new lease standards, first the new revenue standard, and then, most recently spending, several years dealing with the new lease standard and helping our clients both technically from an accounting perspective, but also operationally to adopt and implement and prepare to be, live on the new standard. Matt?
Thank you, Nick. This is Matt Waters, and I'm a CPA. I've been with CoStar as a director of lease accounting for about 6 years now, and during that time at CoStar, we have helped hundreds of companies go live with 842 and IFRS 16 lease accounting projects in lease accounting software. And prior to that, I led the lease accounting team at the Home Depot, where I worked there for about 6 years, and also spent time at American Tower in the lease accounting area. American Tower is a big cell phone tower company with literally hundreds of thousands of leases. And so now I have about a little over 15 years of experience in lease accounting, and look forward to talking a little bit about that today. And before we keep going, I just want to say a big thank you to Nick for joining us today. And Nick, we appreciate you lending your time and expertise to this discussion. So today we're going to be talking about policy decisions for ASC 842. And the reason why we think this is important to discuss really is, as a lot of non-public companies are just getting on their journey to adopt ASC 842, we've been through, as I mentioned, hundreds of projects for compliance with 842 because the public company deadline was, for most public companies, early in 2019. So we've learned a lot from those experiences. And what we found was that, a lot of people underestimated the policy decisions, just the amount and the detail that needed to be considered in those early discussions. I think a lot of companies thought that they would purchase software, and software would just solve the lease accounting, problem, so to speak. But, and that's largely true. Software is a big component of switching from ASC 840 to ASC 842. However, buying software does not solve everything, and the policy decisions really are one of those things. So, again, while software can make it easier, you still have to make these policy decisions. And the key ones that we want to talk about today are listed here: practical expedience, specifically a practical expedient around lease and non-lease components. We've seen a lot of activity around that one, even some people wanting to switch back after adopting an initial policy. They consider changing that one later. A policy around discount rates, fair market values, capitalization thresholds, and finally we'll talk about internal controls. So again, these are some of the things that companies need to think about up front. Software will help, but really there are decisions that need to be made that the software will handle either way. And so what we're going to do today, kind of the format for this discussion, is Nick's going to speak first on each one of these topics, and then I'm going to talk about any software considerations that need to be included in the discussion around the policies, and we'll roll through the list and give you guys some good information. So, Shivani, I think that brings up our first polling question.
Which of the following best describes your company and status for ASC 842 or IFRS 16 lease accounting transition? Non-public company working on transition, non-public company already successfully transitioned, public company already successfully transitioned, or public company already transitioned but looking to make improvements. Please select your answer on the screen and remember to hit submit. We'll give 30 seconds for you to submit your answers.
Nick, I'm thinking here we may have a good portion of the audience at non-public companies. I'm not sure, but just thinking about the upcoming deadline for those companies, that might be our audience. Although, we have been talking about process improvements with some public companies who transitioned a couple of years ago, and now they're looking to make improvements. So be interesting to see who's on board with us today.
Yeah, Matt, completely agree. I think we're seeing a good mix of both the non-public companies starting to really pick this up, and then some of the public companies looking to improve what they did a few years ago. So it looks like here the majority of our audience is non-public, which is great to see. Great to see those groups starting to think about this early in the year and getting a head start on what's to come. So with that, maybe we will move into our first section, and I'll lead us off here. And I want to just echo a few of Matt's comments that he made when talking about our table of contents and things we're going to touch on today. I think the number one thing that we've seen and kind of a takeaway from the early adopters, the public companies that went through this, Matt's exactly right. A lot of companies underestimated what it took to make some of these elections, and ultimately the benefit that they would get by really thinking through these and making these elections for their organization really before they jumped into any type of software implementation. And we'll talk a little bit about how these could impact, ultimately how you're going to set your software up, how you're going to utilize your software, ultimately the data that you're going to put into the software. So, certainly a key takeaway that I hope you all, who haven't adopted the new standard yet will take away is spending that time up front could actually save you a lot of time throughout your adoption process and ultimately, some duplication of efforts as you head down the line. When you think about the new lease standard, and you look at the standard, kind of for what it is, many would say, the FASB didn't do anybody any services by giving you revenue recognition, the new 606 standard, and then leases, in back-to-back years for the public companies, and then obviously with the delays, a few years in between for the private companies. When you think about ASC 842, most would say this standard certainly is not as technical and as nuanced as 606 was, so that's a good thing. But however, there are still, certain elections you need to make and certain nuances within this guidance that you need to think about. I think what we experienced is that this standard, maybe unlike the revenue standard, and again, generalizing somewhat, this standard was much more challenging to adopt operationally. And there's varying reasons for that, and we'll talk a little bit about them as we hit through some of these topics, but, a large portion of it was understanding your lease portfolio, understanding what makes up that portfolio, and then, as Matt mentioned, most companies are needing to implement a software solution. So all of that coupled together, we found that this standard was more challenging, had a longer lead time, longer tail for most companies, than 606 did, which, many would say was a much more cumbersome technical of the two standards. But, luckily when it comes to 842, they did do you some favors and put in some expedients and some elections you can make that operationally, does make this smoother. And this is really some of the bigger ones that are out there. We're not going to dive into every single one of these. I will touch on them briefly. Largely we'll dive into a few of the expedients that we wanted to spend a few more time on. The first set of elections that you really need to think about and make have to do with how you're going to transition. And the first one being the most important, and that's either are you going to take the modified retrospective adoption election, or are you going to defer to the comparatives under 840 option? Now, many of you are probably thinking, wow, we heard that modified retrospective term when we adopted 606. It is completely different. Modified retrospective in the context of 606 was more of a go-forward provision. Modified retrospective as it relates to leases actually means that you're going to go backwards. You're going to recast the comparative periods, and you're going to apply ASC 842 to the lease activity during all of those comparable periods, versus the comparatives under the 840 option, which really just says, hey, we're taking the date of initial adoption as our effective date. We're not going to go backwards. We're only going to look at this thing forward. And really what it comes down to is, do you as an organization or your key stakeholders in your organization want comparability? Now, I think out of the gate, a lot of companies said, well, absolutely, we got to have comparability. We can't have this disconnect, until they actually thought about what that meant. And really what that means is basically a complete duplication of effort to a certain extent, because you ultimately would need to go back a year, oftentimes 2 years, to gather your lease population as of that earliest date, think about what those leases look like, and ultimately calculate an ROU asset and liability, even if those leases were to expire before your adoption date. So it's just a whole nother level of complexity and again, operational uplift that you would have to do. Additionally, when you really break down the comparability, if you do this correctly and you make certain elections along the way, you should have very little to no P&L impact on your transition date. So really, when we talk about comparability, it's really just your balance sheet that's not going to look comparable. You may have some differences from a P&L perspective, but I think most companies, again, if you make the elections correctly and you do this right, you are seeing very little to no change from a P&L perspective. So I'd say 99.9, maybe even 99.9+% of companies are going with that comparative under 840 option. Probably the biggest, most advantageous expedient that was out there is what we refer to as the package of three. And really what this one allows you to do is not need to go back and reassess leases. And that relates to classification, that relates to whether or not it's even a lease, and then how you handle certain costs. So obviously this is a massive time saver for most companies. The one thing to note, if you go down this path, you are making this selection across your entire lease portfolio. So you can't pick and choose and say, hey, I want to revisit, classification of these 5 leases because I think I can get it from, a capital lease to an operating lease, or vice versa. I get it from an operating lease to now be classified as a finance. This isn't all or nothing. So if you open up one lease, you're opening up them all. The one caveat to this, obviously, is that you are not able to carry forward errors. Meaning if you did not have a very rigorous process around how you classified leases historically, or how you determined if something was a lease or not historically, then you're going to need to think about if this expedient can really be applied to you and your organization. Probably a discussion that you're going to want to have with your auditors. Theoretically, your auditors did look at all this stuff in the past, so they're somewhat in the boat with you on this one, right? So you want to have that discussion with them. Again, 99.9+% of companies are electing this package of 3. It's probably one of the biggest operational advantages that you can take through this process. When we think about hindsight is oftentimes referred to as the not so practical expedient, and that really it got that name largely because if you're taking the package of 3, your whole point of taking that is to not have to look backwards and think about your history of these leases and revisit elections. Hindsight is just doing the opposite of actually going back and saying, all right, what's the life of this lease look like? How would it have played out? Should we take into consideration every single amendment, every single change that this lease has had over its life cycle, and then ultimately utilizing that when you get to the balance sheet. So, those are really the ones you want to think about and will ultimately impact transition. And again, you want to make these elections as early as possible in your process. As we then go over to the next column and think about some of the other expedients and conventions, some of these will apply to transition, but they also then apply to your go-forward accounting policies. So the ones in the left-hand column here strictly impact how you're transitioning, no real impact on a go-forward basis. Things in the right-hand column, again, both could impact and will impact both transition and go-forward. When we think about, first and foremost, the portfolio approach, this is one that was oftentimes a little bit misinterpreted by public companies going forward. Also one, as they got into actually implementing, many companies, made the election to say, yes, we're taking portfolio, but as they got into it, ended up changing course, changing that decision and saying, no, we're not taking it. Many companies thought the interpretation around this was that they could really group a bunch of leases together and really account for it as one lease. Most commonly, we saw this in areas such as laptops, copy machines, and then even fleet with vehicles. So while you certainly could say, hey, I get 1,000 laptops all on the same day, and I'm not going to put 1,000 laptops into a lease tool and account for them all individually. I want to account for that as one lease. You could certainly do that, but operationally, a lot of challenges on a go-forward basis if you have issues where you maybe give some of those laptops back early, or you choose to keep certain laptops and give certain ones back. Laptop breaks, you got to turn it in. All of those would trigger modification accounting. Then that would require you to go through and do a total re-exercise of that entire portfolio. Versus if you're looking at those leases individually, and you turn a lease in, then you're going to, obviously make a modification on that lease individually and not the group itself. So many companies started down this path of saying, yes, we want to group everything, but then quickly moved in a different direction, saying, no, we need to think about this individually. Other areas where portfolio approach was taken, more likely was around things like incremental borrowing rates, where you make certain assumptions over certain certain groups of your portfolio, and you would apply one incremental borrowing rate to that group. We saw many of our clients, instead of having an incremental borrowing rate for every single asset for every single year of the term of those leases, they did some grouping, and they said, all right, any lease with a term of 1 year to 5 years, we're going to use a 3-year IBR. 6 years to 10 years, we're going to use a 7-year IBR. 11 to 15, we're taking a 13, and you get on and on and on. So there's certain avenues to profiling that you can take, but it probably isn't the one that most people think when they first looked at this as an expedient. Short-term leases, again, huge operational benefit if you decide to take this. So basically what it says is any lease with a term less than 12 months does not need to go on the balance sheet. Now, obviously, as you think about your leases, when you determine what the ultimate term is and whether or not it's shorter or longer than 12 months, you do need to take into consideration renewal options and your likelihood to renew. And that's a whole nother set of decisions and elections and, really operational approach that you're going to take as an organization around renewals. And we're not going to go there today, but that's a big portion of what this is. But let's just assume, you have a group of leases that, you ultimately determine have a term of less than 12 months. You have the ability to not put those on the balance sheet. And I would say, again, most companies have elected to take this expedient and keep those off the balance sheet. Now, what some ended up doing is still electing to gather all those leases, identify them as part of the portfolio, and in certain cases even put them into their lease software, mainly for operational tracking purposes. One of the bigger, I'd say, operational benefits of this standard is the fact that you are, by implementing some of these different software solutions like CoStar, you are now creating an overall lease portfolio and repository of agreements and of leases. And there's operational value to that. Being able to look at your portfolio, see when things are expiring or come up for renewal, seeing how many different vendors you're leasing, certain pieces of equipment from, and then being able to consolidate those. A lot of clients that we worked with wanted to have that visibility for the first time, in many cases, into their portfolio. So they elected, even on the short terms, to throw those into their lease tool. The next three, we are going to dive a little bit into deeper in the next handful of slides. I won't go into these too deep right now. The lease versus non-lease component we're going to spend the most time on. The risk-free discount rate versus incremental borrowing rate. A lot of private companies on the line today, so I think that's going to be an important one to spend a second, just make sure everybody understands. And then, one that we get a lot is around materiality considerations, or, really should be thought of as capitalization thresholds. When we got a slide on that we'll talk to. I hate to break it to everybody on the line, but the big punchline around materiality is the standard theoretically does not have one. Our brethren overseas that follow IFRS 16, have a little more luck when it comes to materiality. They have what's called the low dollar value asset threshold, which is basically any individual asset in your portfolio with total remaining payments of less than $5,000, can be left off the balance sheet. So they put that in there for you. Unfortunately, ASC 842 does not have any threshold prescribed in the guidance from a materiality perspective. Now, we're going to talk a little bit about that later. Most companies are operationally, practically putting something in, but we'll talk about, the best way to do that. You can't just stick the old thumb in the air and pick a number. You're going to have a little bit of backup and support to get to that. So we'll talk about that. Again, big picture, big takeaway here is the more time that organizations can take to think through these on the front end, get to good decisions, the better off your implementation process is going to be, the better off your software implementation is going to be, the better off your abstraction or taking the data out of your leases and getting into the tools, what we refer to as abstraction, the easier you're going to make that on yourself. Maybe I'll pause there for a second. Matt, anything to add here from your perspective?
Yeah, thank you, Nick. I think just the fact that these are all issues that you need to think about before you start a software project, right? So if you're buying software to comply with ASC 842, you've got to get these things decided. And matter of fact, all of these things we are going to ask you about. So when CoStar starts a project with you, we will ask you what your decision was, about the portfolio approach, about short-term leases and things like that. And so, after hundreds of implementation projects, we've seen, some companies are prepared when we come in and ask these questions. And then, that becomes a relatively quick discussion, and you move on into the timeline of the software implementation project. If you don't have these made ahead of time, well, you can imagine there can be a a week or two delay while you set some internal policies, talk with your auditors, maybe even bring in some accounting advisors if you need some extra help, right? But which is fine, but we just wanted to bring it up to you today. So for those of you that are in the early stages of project planning, you can go ahead and set these up early and experience no delays down the road. So with that, I think we'll dive in to lease and non-lease components. Nick?
Okay, great. Thanks, Matt. Yeah, let's dive into this one. And, a lot of content here. Obviously, as I mentioned at the beginning of the presentation, feel free to download the slides. We'd be happy to take any questions either now or try to get back to you after the presentation. But we'll try to get through this as quickly as we can here and make sure we hit all the content. So lease versus non-lease components, as Matt mentioned in his opening remarks, very topical even as of late. So this was a big decision point during the adoption process. It continues to be a big discussion point as companies continue to refine their processes. And it's largely because there was certainly some unintended consequences of how you thought about, this election. Ultimately what this is saying is you got two choices, right? You can either combine your lease and non-lease components when you're calculating your right-of-use asset and liabilities, or you can choose to separate them. And there's some pros and cons we're going to talk about on the next slide. I think one of the bigger things to think about is when you make this election, you are making it on an asset class by asset class basis, right? So what you decide for your real estate leases doesn't necessarily need to be the same conclusion for your fleet or for your equipment or for your copiers or whatever it may be. So that is one benefit to think through on this one. The other big thing to keep in mind, and Matt's going to talk about this here in a few slides, is that once you make this decision, it is binding. So the only way to really get out of it and reverse it would go through a preferability assessment, which obviously then leads to a lot of more disclosures, more so for the public companies than the privates, but still a hurdle that you'd ultimately need to jump through. So when we think about the pros and cons, it's a little bit obvious, I would say, to a certain extent, in that the pros is first and foremost operationally alleviates the complexity of making an allocation between the various components. And you do that all with a standalone selling price. And we've got an example coming up that'll break this down. I like to refer to this as accounting gymnastics. It is extremely complex and cumbersome and challenging for most organizations to do that. So right there and out of the gate, most companies said, we're going to elect to not separate. So obviously the cons then, when we think about those, it generally is the fact that it will result in a higher liability and right-of-use asset, which ultimately could impact, how you think about classification, and obviously would create some higher lease costs. So again, you have to think about your portfolio. You have to think about, what happens, what would happen as you apply this again to your individual leases. Some interesting stats down below. Approximately 74% of public company disclosures, companies indicated that they are not separating leases and non-lease components. And I would say, for my specific clients, it probably was even higher than that, of companies not separating. And I think about a third of those, the election was made for only certain classes. So again, you could get to a situation where you say, okay, yeah, for this particular asset class, it would make more sense for me to ultimately separate it. So what are we talking about here? What are the different, what's the difference between a lease and a non-lease component? Simplest way to think about it, obviously, is the context of your real estate. And this is probably where it comes into play the most for companies that we work with, and as you may find as you're going through the adoption process. So the lease itself, obviously, would be the building, and what you're leasing. You got to go through the analysis, from an 842 perspective to first determine, is it a lease or not? But assuming you get there, that is your lease component. And then you start thinking about, okay, what could be the non-lease components? And ultimately, at the end of the day, what the non-lease components are things like CAM, common area maintenance charges, things like snowplow removal, electricity charges. Maybe you have, some other provisions within your agreements. You got to sort through all of those. Then there's also this maybe a little bit more confusing notion of what is not a component, and oftentimes that's just your real estate taxes and insurance. So keeping that, I guess, in the context of what you're thinking about, is important as we're starting to go through the exercise and think through the selection. So this slide is meant to somewhat illustrate very simplistically the steps that you would take to allocating. And this is what I referred to earlier as the accounting gymnastics. This slide certainly doesn't do the complexity justice, but basically it's a 4-step process. The first being you need to identify what are all the components in my contract. And then identify, obviously, what are the non-lease components in the contract. And then ultimately you need to determine, using the consideration, what standalone value of all those components would be, the lease components and the non-lease components, and then do an allocation using the consideration of the agreement and those standalone fair values. And using an allocation method, you could go through and ultimately allocate that value. The example now that we have, and we're going to go through this relatively quickly, so I'm cautious of the time, but we'll give you a little bit of a sense of what you got. So we are, again, looking at a building lease here, and really what we've done is identify a handful of different components. The rent, the common area maintenance, taxes, and insurance. So again, based on my last example, rent for the lease is the lease, the CAM is the non-lease component, and then the taxes and insurance do not need to be considered. Now, one thing to note here is that we said CAM, taxes, and insurance are variable. So typically, many of you are saying, well, I did my homework on this standard. Any variable payments I make do not need to be factored into the calculation of my RU asset and RU liability. Well, here's where one of those non-intended consequences come in, is that when you're going through this split of lease and non-lease components in that allocation, you still need to take into consideration variable non-lease components while you're going through that exercise. So in this instance, the $75,000 total payment for the CAM is an estimated amount, and I think my little footnote got cut off there, but the star there next to those 3 values indicate that we are estimating those. So you would need to do an estimation, again, to get to what you ultimately are going to be doing from an allocation perspective. So, ultimately, as we go through here, you'll see scenario 1, if we elected to separate the lease and non-lease components, we're going to determine what the standalone selling price is over the life of the lease, and we're going to determine then of the total consideration, what are the allocation percentages of those? And then, go doing the math across, you find out, okay, of my $500,000 total payments on my rent, only $416,000 of that really goes to the rent, and the rest of that $500,000 is a component of the common area maintenance. So the theory there behind all of this is that the values as stated in the agreement don't always necessarily represent fair market value, standalone selling price. So there's an allocation exercise that needs to be done, even to the variable pieces. So the delta between that $500,000 and the $416,000, would ultimately need to be expensed as incurred at the same time the CAM is. So again, it's accounting gymnastics, creates a very judgmental, challenging step, one the auditors will certainly be digging into if you're thinking of that realm. So just a lot of added complexity. Again, then if you look at scenario 2 where we just combined, there at that point, you just take the $500,000 and, you would go through and calculate your ROU asset and liability, expense it, accordingly, and the CAM would just get expensed, as incurred, and you wouldn't need to do any of that allocation. So again, certainly a much easier operational exercise to think about if you decide to not separate your lease and non-lease components. I'm going to turn this one over to Matt, let him talk a little bit about what we're seeing in the market with folks wanting to reverse that election that they may have made upon initial adoption.
Yeah, great. Thank you, Nick. And I would just say, really, for the reasons Nick just described in his 2 examples, and as he said, over 70% of companies decided to elect the practical expedient, just because it is so much easier, right? On the surface, certainly, you'd rather not have to do all the allocation of standalone prices. Just seems way easier, even though there's a gross up, particularly of the lease liability, is kind of the negative aspect of that. A lot of companies decided that was worth it. Take the higher liability, maybe affect ratios just a little bit, but all in all, set yourself up for a little more ease of operational lease accounting. But then there have been some what we kind of call buyer's remorse about this practical expedient. The companies that used it kind of blanket across their whole portfolio of leases in the first 2 years after adoption, some of them found that it had some unintended consequences. So, for example, if you use it with your IT arrangements, and maybe when you adopted the standard, most of your IT leases were primarily, pretty, straightforward. Most of the dollars were covering equipment, and so there might have been a few services included, but it was okay to lump those together. Then later, just assume that the company entered an IT arrangement where most of the contract was for services, or bandwidth or something like that, with a relatively small asset component, or equipment, physical equipment component to the contract. Well, then because they used they made this policy election, they end up significantly grossing up their liability and right of use asset. And so for that purpose, we see some buyer's remorse on this election. Now, some have had that to such a great extent that they decide they want to try to reverse the policy election. And as Nick mentioned, you do have to show preferability in that case. Definitely, if any of the public companies on the line today are in that situation, I definitely suggest you talk with Nick or somebody, at Deloitte or at your accounting advisor firm, get some advice on that, because you definitely need to have that button down, but it's not impossible. You just have to prove that it's a preferable accounting treatment. Now, from a software perspective, CoStar is going to streamline this either way. We have upfront in our setup with the software. You decide which ones of your lease expenses are going to be lease components and which ones are non-lease components. If you use this practical expedient, they all go into the right of use asset and lease liability. If you don't, they're automatically sorted out, right? So from a software perspective, once you make this election, we make it really easy. You abstract your leases. What you need for 842 goes into the 842 schedule. What you don't need for 842 just gets expensed as incurred. So super easy, but as you'll see, a common theme today, you have to make the election. Before you set up the software, you have to decide on this. And, of course, better to decide up front what's going to set you up for success going forward and avoid any kind of buyer's remorse or wanting to switch gears later down the road. Shivani, that brings up our next question.
Thank you. Did you elect for companies already adopted the standard or plan to elect the practical expedient to combine non-lease component? Yes, at entity level. Yes, for certain categories/asset classes. No, other, don't know, or not applicable. Please remember that in order for your response to be recorded, you must hit the submit button located in the lower right-hand side of your live view presentation screen. This is also an exceptional time for you to submit any questions you might have for our two speakers today. You can submit these through the Q&A box, and our speakers will get to them during our Q&A session.
So hopefully we've given some food for thought on this election today. I mean, knowing that the majority of the audience has not adopted the standard yet, I think we're going to see just the best guess being entered here, Nick. But, you know, certainly something that that hopefully we've given some points to think about.
And here are the results.
Great, thank you. Yeah, certainly not surprising results here. I would say again, it's consistent with what we're seeing, you know, a lot of our clients, you know, doing. So for those of you that haven't or don't know which one, you know, again, hopefully that was helpful to start thinking about, you know. But again, dive into your portfolio, reach out, you know, if you need some help thinking through this, and you know, certainly be willing to have a deeper conversation around the topic if you need it. So with that, let's dive into a couple more of the expedients that we thought we would hit on. We're not going to go as deep as we just went on lease versus non-lease components. I know we only have about 20 more minutes together, but you know, want to hit on a couple things here that will be important. So, you know, obviously one of the more challenging and more, I guess, impactful inputs to adopting the new standard, particularly at the time of transition, is the discount rate. You know, there's really, again, a little bit of misconception around this one as well and how you get to it. The way the guidance actually reads is that the discount rate for the lease would actually be the rate implicitly stated in the lease, unless that rate cannot be readily determined. So in most cases, I would say from our experience, you know, your incremental borrowing rate is not listed by the lessor, right? Part of it is because they don't want you to know what that is. So if that's not readily determinable within your leases, that's when you would move to your incremental borrowing rate, which, again, down there at the bottom, you see the definition of the incremental borrowing rate. And again, one of the bigger things and the keys to this definition is the fact that it must be on a collateralized basis over a similar term and an amount equal to lease payments in a similar economic environment. So very important to think about that component of collateralization as you think about your incremental borrowing rates. You know, luckily, I would say for private companies, you have an expedient here in the ability to use the risk-free rate. But obviously that has, again, maybe some unintended consequences in that, you know, that number would result in a higher number on your balance sheet, which could lead to some changes in ultimately how leases are classified, and then ultimately, you know, could have some impacts on debt covenants and things of that nature, depending on how those are drafted up. So, you know, I'd say it's been a little bit of a mixed bag for the private companies that we've worked with in the market on whether they've done the risk-free rate or they've gone to determine, you know, the incremental borrowing rate. And the incremental borrowing rate, you know, isn't necessarily just intuitive either. You can't simply use your WAC, or you can't simply use the interest rate related to your line of credit or revolver either, because usually those are shorter term or may not be secured or may just be, you know, limited in purpose or even for a group of entities versus the parent entity. So, you know, you need to think about what actually is an incremental borrowing rate. And what we've seen is, you know, especially for private companies that maybe don't have a standard credit rating, and two, maybe don't have access to things like a Bloomberg terminal to be able to pull yield curves. You know, they're having to go out and either leverage their banks to get an incremental borrowing rate or hire some type of evaluation firm. You know, Deloitte, we have a service where we help companies determine their incremental borrowing rates. Others out in the market do as well, but it's an additional cost. I'd say the one thing to look out for when we think about incremental borrowing rates is if you are a private company and you ever have intention of one day being a public company, then if you take the using the risk-free rate, that would need to be unwound the day you become a public company. So that is a little bit challenging, certainly challenging, not a little bit, it's a very challenging exercise to go through, but one that we've had to go through as we're in this golden era of SPACs and IPO transactions over the last 12 to 18 months. So we have seen this quite a few times in practice, and it's certainly not an easy exercise. I think that's actually what the next one says. And Matt, maybe I'll let you talk a little bit about what you're seeing in the market as it relates to discount rates and ultimately how CoStar handles these rates.
Yeah, absolutely. And I'd say this is another issue that that software will be able to accept the rate that you decide is appropriate, right? So if you're using the IBR or you decide to use the risk-free rate, from a software perspective, you can type that in. You can research it every time and type it in, no problem. But what we found here is that this was an opportunity for automation to really help save some time. And so what we've done at CoStar is we've introduced a discount rate lookup feature. And what that means is you can have somebody maybe in your treasury department upload a table of rates periodically. So some of our customers do this once a month, some once a quarter. It's up to you, but you upload a table of your rates and you split those out into buckets. And the buckets I'm referring to would be things like a 1 year to 5 year lease, a 5 to 10 year lease, then further split up into portfolios. So maybe one set of rates for your real estate and another set of rates for your equipment portfolio. And then you can either further split it out by geography and currency. And so you can imagine there you can get very detailed and precise as far as your policy goes on which rate to use. But then the beauty of it is once you upload it into CoStar, the software is going to automatically select the appropriate rate for every single new and revised lease accounting schedule. So really takes the kind of the legwork out of it. You don't have to run to the Treasury Department or to a Bloomberg terminal or call your banker every time you get a lease. You just have this process set up, and the software will automatically pull in the discount rate for you. So saves a lot of time, and it's one feature that we've actually had a lot of favorable reviews from our customers on. Okay, Shivani, that brings up the next question.
Thank you. Do you currently use a software solution or plan to use a software solution for lease accounting? Yes, a current user. Yes, planning to use a software solution. No, planning to use spreadsheets for lease accounting. Other, don't know, not applicable. Please remember that in order for your response to be recorded, you must hit the submit button. And please submit any questions you may have for our speakers through the Q&A box, and they will try to get to as many as possible at the end of our webinar. Thank you. And here are the results.
Okay, pretty even spread here, Nick. I mean, I think there is certainly a path where you can use spreadsheets, and we get asked all the time, at what point do you need a software solution? And, I'd say it depends on the complexity, and the number of leases. But, over maybe a couple of dozen of leases, you might want to start thinking about software and give yourself, kind of a better control environment. We're going to talk about that a little more later. But again, that's a number that depends on the complexity of the leases. Certainly once you get into the hundreds of leases, the software starts to really make a lot of sense.
Yeah, I would agree, Matt. Certainly one of the number one questions we get, especially, as we've started to talk to a lot of private companies in the market, is what is that threshold? And completely agree. Usually my number is anywhere from 20 to 25 leases or more. You're probably in some kind of a software solution. And you're exactly right. I mean, as an ex-auditor by trade, the more we can get out of spreadsheets and manual manipulation, the better off we're going to be. And, I'd say one of the bigger things, it's also not only just calculating your ROU asset and liability that the software tools are really great for, but it's also all of the reporting. And again, I think often underestimated is the quality and the level of reporting that comes out of a tool like CoStar. As you go to do your disclosures, being able to push the button and get the reports that you need versus then having to manually manipulate, different amounts of spreadsheets, types of spreadsheets to get you to those same numbers. So certainly something to think about. All right, I know we're closing in here on about 10 minutes. I want to get to a few other topics, so I'm gonna go quickly. I think this is a very important one on fair market value, largely because, again, operationally, one of the more challenging inputs to get, because obviously it's not stated in the lease in most cases. So you got to have an avenue and a process within your organization to go get your fair market values, and that's going to be needed upon initial input into the solution and ultimately your capitalization or classification test. You'll need it again if you have situations where you reach impairment or for whatever reason you go through a business combination. So this is going to come up maybe a little bit more than you think, and certainly has been operationally challenging for organizations. But again, one of the areas that CoStar has done a great job on, and Matt, I'll let you talk a little bit about your fair market value features.
Yeah, thank you. And so CoStar, we have a lease accounting software, as you, I'm sure, are aware by now in this presentation. We also are the leading provider of commercial real estate data. So what that means for our lease accounting customers is you get to leverage that data for the properties that you occupy, that you abstract into the lease accounting software. You get to see market data from CoStar Research. And so let me put a little bit more context around that. The typical path to obtain fair market value information is the accounting department needs it, right? For example, for a classification test. They call the real estate department. Real estate department calls the broker. The broker most likely looks up the information in CoStar because all major brokers have a subscription to CoStar for that purpose. Then they create an estimate. They send the estimate back to the real estate department, who then sends the estimate back to the accounting department. So not a bad process. I've as a lease accounting practitioner, I've done that hundreds and hundreds of times. But the thing is, it takes like a week for those emails to go back and forth, and the data is there instantly available in CoStar. So, of course, to the extent your accounting department can have this data at their fingertips, you can set a policy on how to apply the data to arrive at a fair market value estimate. They can do in a couple of minutes what they used to have to wait a week for. So just a big step in terms of efficiency there, and really puts the accounting team in the driver's seat, not just for the initial lease classification, but also for impairment testing and also for above or below market leases when you have a business combination. So really cool functionality there. And Shivani, that brings up our next question.
Which of the following do you think your company is the least prepared to address? Discount rate determination, fair market value determination, lease versus non-lease component decision, other, don't know, not applicable. Please select your answer and remember to hit submit. We will give 30 seconds for you to finish all your answers.
We got a couple more sections here to talk through, Matt, after we get through this. But again, hopefully everybody has, had a couple things to take away from our discussion so far. And again, I think, one of the biggest things I want to reiterate to the group is, the more time you can spend thinking about some of this stuff, before you dive into software, certainly the better.
And here are results.
All right, great.
Excellent.
And
thank you.
Nick, I'll say let's dive right in to the next topic.
Perfect. Yeah, so I think this is one, maybe we left a little cliffhanger here on the capitalization thresholds, but this is oftentimes one of the questions I get the quickest from my clients as we start through thinking about expedience and other elections they make. And again, punchline is the guidance as written does not give you a materiality or a capitalization threshold, but operationally, most companies are putting one in, and actually they're finding that it's oftentimes a little bit higher than what they would expect, and oftentimes a little bit higher than what they're using from a fixed asset perspective. So, no different than your fixed asset capitalization thresholds that many of your organizations have in place. That's where this lease capitalization threshold would be. And really, again, you can't just stick the thumb in the air and say, hey, I'm going to make it $5,000 or I'm going to make it $10,000 or whatever your number is. There's got to be rooted in some facts. And really the way that we do this with our clients is, first and foremost, you got to gather all your lease agreements. And you have to know, as of your effective date, what's the remaining payment on all of these leases to determine overall how much is out there from a lease commitment perspective. Now, many of you are saying, well, I got my 5-year commitment table under 840. Well, again, one of the biggest operational challenges and aha moments of this standard is that I would say most companies, as they really went through a true completeness procedure, we're finding they have more leases than that. So do the activity, figure out what your population is, and then you'll be able to draw a line in the sand. You say, okay, everything under this value, $7,000, the sum of all the remaining payments of those leases would not be material to my balance sheet. Therefore, that's where I'm going to set my materiality level. Now, again, this will need to be revisited periodically. You will need to take things into consideration, like changes in the organization's strategy, whether that be, you're moving from, hey, we always leased everything to now we're buying everything, or vice versa. You make a big business combination, it changes the whole complexity of your portfolio, or changes how many leases you have, the dollar values, terms. You would need to revisit this. It can't be a set it and forget it policy. So punchline, again, no threshold in the guidance. You need to do something to evidence that you thought about how you got to that number for purposes of your auditor, most likely. And then real quickly, and then Matt, I'll turn it back to you maybe to shut us down here. I did include some slides on internal controls. Again, if you're a private company, you're probably saying, look, internal controls don't mean a lot to me. I don't have Sarbanes-Oxley requirements. Your auditors most likely will still want to see something around controls, and you operationally as an organization should want to have some control around this process. From an auditor's perspective, even from if you're a private company and your auditors don't look at your controls, rely on your controls, they are required under AICPA standards to still look at the process and understand your process for significant risks. And oftentimes the adoption of a new standard in a given year would fall into that category. So again, have that discussion with your auditor, understand what they're going to want you to do. But operationally, you're most likely going to want to have controls as an organization. And a lot of them is around, again, transition. How are you adopting the standard in general? One of the more challenging aspects of the standard on a go-forward basis is reassessments and modifications. How are you going to get information from the field back to those ultimately doing the accounting to determine if you have an accounting modification or not? And there's impacts around that. Again, a whole nother can of worms we won't open up on this call. Happy to talk offline. If you have questions around those. So those are certainly some of the more intricate and complex areas of the standard that you'll see. And then I think lastly, thinking about your controls, around reporting and disclosures, again, one of the biggest reasons not to use Excel is that you have then the controls, within the solutions themselves to do reporting and disclosures. And then obviously anytime you introduce a new system, you're going to have certain IT controls that need to be considered. And then obviously if you're using some kind of outsourced provider, getting the SOC 2 reports, thinking through all of those aspects like you would, with any other service provider. So I will take a big deep breath there, hand it over to Matt to close this down.
Great. Thank you, Nick. And I'd just say on this from a software perspective, be sure to select a software that has configurable internal controls and workflow. You should be able to set your policies up. For example, who needs to approve journal entries, who needs to approve lease payments before they go out the door. Make sure that that's configurable and that you can track it. Make sure that your system doesn't just count the clicks. Make sure that you can get a meaningful report that you can hand over to your internal and external auditors to prove your internal controls are in place and functioning as you intend. So Nick, let me again say thank you to you for being with us today and providing your expertise, and thanks to the audience for joining us. And Shivani, I'll turn it back over to you.
Thank you. This marks the end of our webinar. Thank you for joining us today. We look forward to you joining us on future webinars. You can find information about upcoming webinars in the Resources widget. Don't forget to download your CPE certificate in the Certification widget. Your CPE certificate will also be available to download in the Thank You for Attending email that will be sent within the next 24 hours. If you have any questions regarding CPE credits, please feel free to email cons@financialexecutives.org. Have a wonderful day, and again, thank you to all of our speakers for today's webinar.